All right, let's get straight to it. The Nigerian FinTech Regulatory Commission bill, it's being sold as a win for the ecosystem. Our audit shows it's a shakedown, plain and simple. Time to get clinical.
Look, this was never about safety. It's about control. And as you're about to see, when regulators decide to fight over turf, it's innovation that always pays the price. So first, let's just quickly go over the official story. This is let's call it the PR version that the bill's sponsors are pushing. And you know what? On the surface, it sounds pretty good.
The pitch is incredibly simple, a single, one-stop shop for all things fintech regulation. The bill sponsor even claims this will enable the ease of doing business. It's supposed to end the fragmented oversight, protect you, the consumer, and boost investor confidence. It's a neat, tidy package, perfect for a headline. But the reality? Well, that's something else entirely.
Okay, now let's dismantle that narrative. This isn't about making things simple. This is about manufacturing a conflict, a jurisdictional war that's designed to benefit the big guys. And here's the crucial point you have to understand. The legal framework for this stuff already exists. It's called BOFIA, the Banks and Other Financial Institutions Act of 2020, and it already gives the Central Bank of Nigeria exclusive statutory power over this entire space. They are the established authority, period. And this slide right here lays out the central conflict perfectly. The new NFRC Bill, right there in Section 31, says all fintechs must get a new NFRC license. But here's the kicker. It doesn't touch Section 3 of BOFIA, which gives the CBN exclusive power. Trust me, this isn't an oversight. It's a legal trap. So what does this create? Well, we're calling it the Dual-Watchdog trap. Startups are now caught in a pincer movement. They have to serve two masters, which means they have to pay two sets of fees and somehow navigate two sets of rules that could completely contradict each other. It is a manufactured nightmare for any founder. And hey, you don't have to take our word for it. Just listen to the people on the ground. This is from Maxwell Loco at OPE, a major operator. He's confirming the risk right there. Duplication, overlapping supervision, and of course, increased costs. The people actually building the ecosystem, they're sounding the alarm bells loud and clear. Which brings us to a really key concept here, the compliance tax. You have to understand, this isn't just more red tape. It's a direct, non-productive cost that's being levied on innovation itself. Every single dollar a startup now spends on lawyers and duplicate license fees is a dollar they can't spend on building their product or getting new customers. It's a tax on their very survival.
So that begs the obvious question, right? If this new bill creates so much chaos and cost for the innovators, for the startups, who exactly stands to benefit from it? And when you look at who's lobbying for this bill versus who's fighting it, the battle lines become crystal clear. On one side, you have the innovators, companies like OPE and Fair Money, warning about duplication and uncertainty. And on the other side, well, you have the incumbents, the telco and agent associations. They don't see a threat. They see a massive opportunity. And here's why. This bill helps them build what we call a regulatory moat. See, for a multi-trillion naira company, that compliance tax is just a rounding error on a spreadsheet. But for a seed-stage startup, it's fatal. The complexity in this bill isn't a bug, it's the main feature. It's a weapon designed to crush the competition before it can even get off the ground. Okay, so the landscape is fundamentally shifting. As analysts, we have to ask the critical question, where does the smart money go now? This is what we call the alpha rotation. The principle is really, really simple. In a regulatory war zone like this one, you don't bet on the soldiers fighting in the trenches. You bet on the arms dealers. So let's look at the numbers. First up, MTN Nigeria. In the last fiscal year alone, they pulled in 2.9 trillion naira just from data revenue. That is a massive surge, and for the first time ever, data is now their single biggest source of income. Now, let's add their main competitor to the mix. Airtel Nigeria. They brought in roughly 700 billion naira from data in that same period. These guys control the pipes. They own the actual infrastructure everything else is built on. So you put them together, and you are looking at a combined data revenue stream of nearly 3.6 trillion naira. This isn't speculative VC money we're talking about. This is hard, recurring, utility-grade revenue. And when you put these two things side by side, the disconnect is just staggering. It's not even a fair fight. On one hand, you've got the telcos with this massive, stable 3.6 trillion naira revenue stream.
And on the other, you have the entire fintech sector fighting over a shrinking pool of VC funding, a pool that's now being drained even faster by this new compliance tax.
So the tactical move here is obvious. While the fintechs are about to get bogged down in a regulatory swamp, the telcos are just printing cash. The smart money rotates out of the chaos and parks itself in the utility. All right, let's bring it all home. Here is our final bottom line audit of this NFRC bill. The key takeaway is this. This bill does not create clarity, it creates conflict. And in a world of dual licensing and overlapping rules, the only companies with the resources to survive, let alone thrive, are the giants who already own the digital infrastructure. And that leaves us with two very critical questions. For the founders out there fighting to build the future, can your balance sheet actually survive this new compliance tax? And for investors who are allocating capital, are you betting on the innovators who are now trapped inside this maze, or are you betting on the architects of the moat? Choose very carefully.